Hey guys, welcome back to the channel. So in this video, I'm going to show you how to beat the next stock market crash. It's definitely coming at some point, and watching this video until the end will give you a good game plan to come out of this next stock market crash stronger than ever. And if you guys want some free stocks, make sure to use the links below to get 2 free stocks from WeBull and 1 free stock from Robinhood. Let's get started. So what's the best way to prepare for a stock market crash? It's pretty simple. You want to study the past crashes, learn from what happened, and then create a logical game plan. By far the worst stock market crash in the history of crashes happened in 1929. On October 29th, 1929, 16.4 million shares were traded on the New York Stock Exchange in one single day, losing about 10% and billions of dollars in equity. This eventually led to the Great Depression, where stock prices were down as much as 80% and took over 20 years to recover. So we want to think, why did this crash happen, right? Right before, there were 6 years of crazy growth, low wages, lots of debt, and a lot more. But there is some good news, and it's because I really think it'd be impossible for this type of crash to happen again. The government ended up enacting a bunch of safe measures after, like FDIC insurance, as well as unpegging the dollar from gold. They also learned to never increase interest rates during recession, and rather lower them to stimulate economic growth. The next crash was in 1987 as the result of a computer glitch that triggered a bunch of stocks just be automatically dumped. This basically led to a 23% decline in prices in one single day. Now, fortunately, those stocks recovered in about 1.5 years, and this just shows that sometimes crashes can be completely random with no foreshadowing. Thankfully, there are now things put in place that temporarily halt trading to prevent mass mania like that. And then next up is the dot-com bubble crash in 2000, which showed that new technologies can incite hype and crazed buying. It's interesting because of all the crashes in the history of the United States, the next stock market crash that we will see is going to be most similar to the dot-com crash. At least that is my opinion. But yeah, we saw some absolutely insane gains in the few years leading up to the crash, followed by an absolute annihilation in the NASDAQ. For example, Pets.com literally hit $14 a share in the year 2000 and then ended up dropping all the way to bankruptcy. Even companies like Yahoo never recovered, eventually being bought out by Verizon Media in 2017. A decrease in interest rates meant capital was really cheap, and the Taxpayer Relief Act of 1997 lowered the top marginal capital gains tax in the United States, which basically meant that people were down to invest a lot of money in companies. So yeah, we have these people going wild. They're just putting any money they can into any internet-related company, and you can see the amount of these deals and money invested shot up to over $30 billion in the span of just 1 year. And then the last big crash we had, besides the one that started the beginning of the pandemic, was the 2008 crash. Banks were doing stated income loans, which meant that you could tell the bank you made $100,000 per year and they would just believe you. I know when you say that loud right now, it just seems absolutely crazy, but at that time, the rules were a lot less strict, so that's how that was able to happen. But yeah, as a result of that, we saw a ton of mortgage fraud, which led to defaults of borrowers, which led to the banks defaulting. And since these banks sold these loans to investors in the form of mortgage-backed securities and other stuff, it just created this domino effect, which ended up crashing the stock market as well. Now, this won't happen again ever, in my opinion, because loans are a lot tougher to get now, and the regulation is much, much better. But yeah, it took about 4 to 5 years for us to fully recover from that, and since then, the stock market has just exploded in value. Now, the pandemic crash in the year 2020 was literally nuts. It was definitely a scary time because we didn't know if the world was ending and all businesses were going to go out of business. So as a result, we saw a 33% drop in the S&P 500 in just a couple weeks, followed by the fastest recovery ever. To put it into perspective, it takes about 1,100 trading days on average to recover losses after a crash. And that's just based on the history of past crashes. As bad as the pandemic was and still is, it created a lot of change in the world, which allowed for new technologies and companies to thrive. So yeah, that combined with inflation plus a bunch of other stuff is why we've seen the market just really go up in the last year. All right, so now let's get into the section of the video where we talk about whether or not the stock market is going to crash soon. We'll We'll go through some detailed examples, and I'm going to share my reasoning with you. The first thing I'm going to say is that it's nearly impossible to actually predict a crash. If you could predict crashes, you would definitely be very, very wealthy. Probably the wealthiest person in the world. Now, that being said, there are a few indicators that we can look at. So in this video, I actually wanted to explore the Shiller PE ratio, also known as the cyclically adjusted price to earnings ratio. The Shiller PE ratio is the price of the stock divided by the average of 10 years of earnings adjusted for inflation. It allows us to sort of predict whether or not a stock is under or overvalued by comparing its current share price with its inflation adjusted historical earnings record. Now, a high Shiller PE ratio would mean that a stock could be more overvalued, and a smaller Shiller PE ratio means a stock could be more undervalued. If we take a look at today's S&P 500 Shiller PE, we can see that it's 38.57. And you'll see that we are higher than each historical crash besides the dot-com bubble. In 1999, that reached almost 45. And besides that, the Black Monday crash happened at around 17, and the Black Tuesday crash happened at around 30. Now, just because the Shiller PE is at one of its highest points we've ever seen doesn't mean that a crash is right about to happen. The Shiller PE tends to trend upwards, and we also have no idea how much higher it can get before crashing. There are also many other indicators we can look at, so it's really complicated to guess. For example, crashes tend to happen when there's too much money in the market. This tends to happen when the interest rates are low, because that means that people can borrow money to put that money into other investments, and then those investments can get overvalued. Right now, I will say that there is a lot of money in the markets, and interest rates are definitely very low. Another thing we can look at is the state of speculation in the air. Right now, I'd say that there is a lot of speculation in the markets, which can mean high PE ratios and fear of missing out. We also have tons and tons of new investors putting their money into the markets, which actually makes everything more complicated in my opinion. The market now is more fundamentally different than it used to be, since the people who trade in it are much, much different. So a lot of indicators show that yes, a bubble is being formed. But if you look at the data about timing the market, you'll quickly see why it's impossible to try and buy low and sell high and do that consistently in the short term. So this chart by CNBC shows what it's like to miss the 10 best and worst trading days per decade. Basically, if you accumulate all the data between 1930 and now, we see an average price return of over 17,000%. If we exclude the worst 10 days per decade, we're actually at 3.8 million%. And if we exclude the best 10 days per decade, then we're only at 28% gains. And then combining those two, if we exclude both the best and worst 10 days per decade, then we'd be at over 27,000% gains. This just confirms the fact that huge changes happen on single days, and trying to time the market means that you'll likely miss out on those specific days. Also, sometimes the stock market just doesn't make sense. Yes, the market is technically probably overvalued right now, and it could continue to do this for many, many years, as we've seen in the past. That means that if you sold all your stocks right now, you can miss out on tons and tons of gains. So in conclusion, I'd say don't sell everything and expect to buy it all back when the market drops. It's very, very unlikely that you'll be able to predict the sell point as well as the buy point. If you're investing for the long term and not trying to swing trade or day trade, then you have the evidence of history on your side, and you are almost guaranteed to make significant money. Now let's talk about predictions for the next market crash. Personally, I don't think that we are going to see one in the year 2021. There's just too much advancement and untapped growth going on right now. But yeah, I think we might see something in 2022 or 2023. But who am I to say that? I'm just some random guy on the internet that makes content. Now, what should we do with this info, and what am I personally doing? Well, first of all, don't do something just because I'm doing it. I'm definitely not an expert, so you definitely need to do your own due diligence before trusting my opinions blindly. But yeah, for me, I'm still buying index funds and stocks slowly, although the amount of money I'm putting into the markets right now is a lot lower. Oh, and I'm barely selling any of my stocks. My decreased investment in the stock market comes down to 3 different reasons. First is I think I already have enough money in the markets compared to my net worth. The second is I do think that there is a crash that might happen in the next couple of years. And then 3, I do want to diversify a bit more. So I am trying to route money more into real estate rather than stocks, because I don't think I have enough money in real estate right now. For me, there are a bunch of tax benefits to buying real estate, so that's why I'm focused on doing that. Now, for you guys watching this video, my advice would be to maybe slow down your investments if you agree with what I'm saying. Definitely still max out your retirement accounts with as much money as you can, but when it comes to putting additional money in, maybe just put a little bit less. And like I said before, only do this if you agree with what I'm saying. If you ever stop investing completely, it just removes your momentum, so it becomes hard to invest in the future. So definitely keep investing in things you believe in, which are hopefully majority index funds like VOO, and work on increasing your income so that you have more cash to invest in the future. This ensures that you'll take advantage of highly probable long-term stock market gains and come out really ahead in terms of future net worth. Oh, and I'm also routing more money into my business and self-improvement because I'm certain that those things can pay me better returns than the stock market, which is something that I'm absolutely not in control over. So if you do have something you have high conviction in, for example, yourself or a business that you're working on, then maybe your money is best spent there. It's really a game of where should I put my money? Remember, stocks is just a small portion of what you can put your money into. Real estate, a business, gold, watches, self-improvement, exotic cars, bonds, the list is really endless. In my opinion, you can start building up cash if you want, but always put a majority of your savings into at least some type of asset. Yes, I know that was a lot of opinions in this video, especially near the end, so I don't want you guys to take this all as the truth. This is just my estimate of what is happening and how to best handle it. Again, if you guys want some free stocks, I will put links to both WeBull and Robinhood in the description below. But besides that, I want to say just thank you for your time, thank you for watching this video, and I really hope you guys got some value out of it. If you did, make sure to hit that like button and also subscribe to my channel to see more videos just like this. I make a ton of content about personal finance, investing, and entrepreneurship. I'll see you guys in the next video. Peace.